Hey, everybody. My name is Justin Guay. I'm the Director for Global Climate Strategy at the Sunrise Project. We are a global environmental organization headquartered in Sydney, Australia, but with staff across Europe, the United States, and a growing global presence. I myself am actually physically located in Utah, in the western part of the United States, but have many good friends and colleagues in India, and am very happy and delighted to be able to talk with you all today, even though I physically can't be present. So I wanted to chat a bit about some of the high-level global trends we see in fossil fuel finance, a topic that is near and dear to our hearts. So the first and probably most obvious trend we see is that there is now an increasingly secular shift in the global financial system away from coal. And so what you're looking at here on this slide are some of the most recent data as reported by the World Energy Investment report from the IEA, and it shows a very clear and declining trend in global coal installations over the last 5 years. Obviously, as coal installations decline, so too will investment volumes. But I think the untold story is that part of what's driving that overall decline and what's driving the decline in investment is that, according to IEFA, a leading global think tank on financial and economic issues, over 142 globally significant financial institutions now have a coal exclusion policy. Those exclusion policies cover all forms of financial services, everything from insurance for new projects to loans for companies building new projects to bond offerings that support the expansion and ongoing maintenance of coal facilities, and everything in between. And so that is a very significant number of institutions around the world. It's not just relegated to Western institutions. They have tracked institutions across Asia making these kinds of commitments. And probably most importantly, we've seen that the rate at which they are being announced is growing quite rapidly. So in 2020, despite a pandemic, despite a near global recession, these exclusion policies were announced at a rate of faster than once every week, which was the fastest rate that IEFA has tracked over the past 3 to 5 years, which means that the financial system is increasingly deciding that coal is simply too toxic, too risky to invest. But that shift, that trend is not confined just to coal. Increasingly, financiers make no distinction between coal, oil, and gas. They simply want less risk, less exposure to fossil fuels across the board. And this trend is most marked when it comes to new new exclusion policies being announced by financial institutions when that cover oil and gas. So, according to IEFA, over the past 2 years now, new policies that have been announced are actually growing more rapidly that cover oil and gas, not just coal. Now, it's important to note that the number of overall policies that IEFA tracks when it comes to coal cover both new policies, so an institution that had not previously excluded coal, as well as revisions of existing policies. That's important because what we've also seen is that while institutions are announcing new policies to exclude coal quite rapidly, they're not doing that simply as a check the box exercise. More often than not, they go back and they strengthen those policies over time, which is a reflection of the fact that this is not simply a PR stunt, it's not a CSR exercise. They truly believe that coal is a toxic and risky asset, and they are looking to reduce their exposure increasingly or with increasing stringency over time. So we've seen that story unfold for coal for many, many years. But as you can see from this slide, it's only just beginning to unfold for oil and gas, with some of the first policies being announced in 2017, which means that we have seen mostly new policies being passed. They're fairly narrow in scope, mostly ruling out Arctic and tar sands, specific project types, which is a trend line we saw happen or unfold very similarly with coal, which, with some of the early coal exclusion policies covering the most extreme versions. But that shift, that trend is not confined just to coal. Increasingly, financiers make no distinction between coal, oil, and gas. They simply want less risk, less exposure to fossil fuels across the board. And this trend is most marked when it comes to new new exclusion policies being announced by financial institutions when that cover oil and gas. So, according to IEFA, over the past 2 years now, new policies that have been announced are actually growing more rapidly that cover oil and gas, not just coal. Now, it's important to note that the number of overall policies that IEFA tracks when it comes to coal cover both new policies, so an institution that had not previously excluded coal, as well as revisions of existing policies. That's important because what we've also seen is that while institutions are announcing new policies to exclude coal quite rapidly, they're not doing that simply as a check the box exercise. More often than not, they go back and they strengthen those policies over time, which is a reflection of the fact that this is not simply a PR stunt, it's not a CSR exercise. They truly believe that coal is a toxic and risky asset, and they are looking to reduce their exposure increasingly or with increasing stringency over time. So we've seen that story unfold for coal for many, many years. But as you can see from this slide, it's only just beginning to unfold for oil and gas, with some of the first policies being announced in 2017, which means that we have seen mostly new policies being passed. They're fairly narrow in scope, mostly ruling out Arctic and tar sands, specific project types, which is a trend line we saw happen or unfold very similarly with coal, which, with some of the early coal exclusion policies covering the most extreme versions of coal mining, including mountaintop removal mining in the United States, which means that the foundations now are being laid for increasingly stringent exclusion policies on oil and gas going forward, which is a really important trend line. But it's not just exclusion policies that are being announced. The broader momentum and power of the divestment movement continues to grow, with over 14 trillion in assets under management now having a divestment screen. This is powerful not only for its impact on the cost of capital, but also because it removes the social license and the ability to operate for many fossil fuel companies who find it increasingly difficult to secure the services of the enabling industries, including underwriters and ad agencies and others that they need to continue to operate. One thing to note on this as well is that while divestment is a broad-based and powerful movement, increasingly leading financial institutions around the world are using the criteria set forth by a group in Germany called Urgewald and a tool that they have built called the coal exit list. The coal exit list sets important thresholds that define what a coal company is, and they ratchet those thresholds down over time, which means the act of divestment is not necessarily a binary thing. Companies can and do find themselves getting off of this list when they get rid of coal assets in their portfolio. It also means that it's only a one-way trajectory in terms of the stringency and power of these divestment decisions. Companies that avoid divestment scrutiny early on may find themselves on that list if they don't continue to change the course of their investments in their portfolio. But that's largely a story of voluntary action, voluntary exclusion policies, and we know voluntary action is simply not enough to address the climate crisis, let alone drive the clean energy transition that's necessary. And so the need for regulation, outright regulation of financial flows, is obviously necessary. And this is probably the most important thing that has happened over the last few years, which is that the need for regulation is now being met by the credible threat that it will actually occur. This is most live in the European Union, which most recently passed the sustainable taxonomy or the green taxonomy, which seeks to classify investments on a continuum of increasingly clean to increasingly dirty, which will, of course, drive investment away from fossil fuels over time and into clean energy solutions. But it's not just Europe. In the United States, on the heels of a Joe Biden victory, the topic of financial regulation and the power of the Dodd-Frank Act, which was passed to curb investments in speculative activities, including speculative investing in fossil fuels, given the fact that we know fossil fuel infrastructure can simply not exist just a mere decade or two from now. It gives regulators the power to actually curb those investment flows. And so I think the changes happening in Europe and the United States could have far-reaching ramifications around the world. And of course, it's not as though nothing is happening in Asia. There are stress tests being planned in Japan, which will reveal the extent to which the Japanese public balance sheet is exposed to the risks of coal, oil, and gas assets being stranded. And there are very interesting progressive moves from Singapore in the form of the Monetary Authority of Singapore and, of course, the central bank in Malaysia. All to say that financial regulators are really waking up to the fact that they need to rein in the risk of fossil fuel investment because increasingly they see it as a threat to the stability of the financial system. And last but not least, if we have voluntary policy movement, we have now a credible threat of regulation. The other thing we're starting to see is investors waking up to the power that they have over the companies they own. Put simply, when investors flex, companies bend. And so this is a smattering of headlines that we've seen over the last year or so, showing the example of that power when wielded powerfully and wisely. And so I think it's been most obvious in the utility space, where we've seen a rash of net zero commitments from leading utilities, especially in the United States. And we hear over and again that one of the single biggest motivators for them to announce those new policies and start to shift their capex has been hearing from their shareholders and shareholder pressure, which means that the financial system, investors, banks, all the different institutions that enable the flow of money throughout the economy are increasingly becoming a political constituency that is rowing in the right direction, meaning they are trying to shift the economy away from fossil fuels and into clean energy, not towards it, which will, of course, have serious and significant repercussions for political and regulatory changes. So all three of those buckets of pressures, all three of those headline trends, a dramatic increase in voluntary exclusion policies, the increasing rumblings and real world regulatory measures being taken by financial regulators, and the power being wielded by investors and stakeholders is starting to cause the cost of capital to rise for all fossil fuels. In fact, it's already started. And so what you're looking at here is data from the University of Oxford, which has conducted surveys of institutional investors in the United States and North America over the past several years to find out what the hurdle rates, what the cost of capital is for various energy types. And as you can see from that very large bar on the far right, increasingly coal is being singled out as the most risky asset and therefore having the highest cost of capital assigned to it. But it's important to note it's not just coal. Even though the increase is smaller, you can see that compared to wind and solar, various forms of oil and gas development all face higher hurdle rates for new projects than wind and solar do, which means that increasingly investors are internalizing these risks. They're recognizing that fossil fuels are a problem, and they are starting to penalize them for it. But maybe the most important quote is on the bottom left-hand side of that slide, which came from one of the interviews the University of Oxford conducted, which shows kind of the non-binary nature with which, or the lens through which investors are viewing this transition. What return do you require for something that could be abolished? There is no hurdle rate high enough to justify losing all your money, which is an important trend line. But despite all those trends, the reality is we're still not on the right track. Fossil fuel finance is actually still growing. So just since the Paris Climate Agreement was signed, leading global banks have channeled $2 trillion into fossil fuel expansion, mostly oil and gas, because of course the trend line for coal is down and sliding further. which means that despite all these positive trends, there's still a long ways to go. But there is a silver lining to this, which is that pretty much everywhere you look across the financial system, there is an ironclad rule that reveals itself, which is that money matters to fossil fuels, but fossil fuels don't matter to money. And so even for these institutions that are channeling billions of dollars to banks every single year, the reality is that a very trivially small portion of their total loans go to oil and gas. And so just to take a very specific example, Chase, which is the world's largest financier of fossil fuels, only 1.4% of their total loan book is for oil and gas, which means they would not miss oil and gas business if they were to decide to stop it tomorrow. And I think that is a very important and powerful enabler of the shift, because their future is not wedded to fossil fuel projects, to fossil fuel profits. And increasingly, as they face pressures from shareholders, governments, and the public, it's highly likely they decide that their future is not best suited as being tightly wound up with the future, or the lack thereof, of the fossil fuel industry. So those are just a few thoughts I wanted to share with you all. Thanks again for the opportunity. And if anybody would like to be in touch, this is my email on this slide, justin@sunriseproject.org.au. I would love to have a chat. Thanks so much.
Viability